Hey, welcome to the post-market review for December 12th. And we can see that today we had PPI numbers come out. CPI came out right on target yesterday, and today PPI was much higher than expected. And so that was a pretty big miss for the Fed, and the SPY before hours traded down on that news. But you can see it didn't have a big effect. We recovered fairly quickly within the hour of opening, and we went back up. And then towards the later half of the day, or 1/3 of the day, we started trading down in the SPY again. Overall, though, it just really wasn't that significant of a move, whether it was up or down or wherever we closed on the day. So if we look on the daily, you can see that all we did was trace back down to the EMA 8. We've been there 2 days ago, and we're right back there. So basically, the CPI report helped bring us up, and then we came right back down. Now, I just attributed that to the CPI report and the PPI report, but in reality, what we should say is that there really wasn't that much effect, whether it was the CPI or the PPI. If you didn't know that those reports came out, you couldn't tell the difference on the chart. It just really looks the same, more of the same stuff. This very low intraday range, this low volatility, just kind of creep and mostly trading sideways. We were talking about how we might just drift a little higher or just trade sideways probably for the rest of the year. Santa Claus rally, this is it. It's not going to be some giant, huge move upwards. If we do see a positive effect or a bullish effect, it's really just going to be more of this drifting upwards. Most likely. I can't say that with 100% certainty, of course, but that's what it's looking like most likely is going to happen here. Now, one thing that we want to consider is that for the most part, the market was expecting, a lot of people were expecting this to be a big drop down because of that big miss in the PPI report. But we have to kind of be sensitive of where we are in the markets. Pretty much since September, and actually even a little bit earlier than that, this market has become more and more desensitized to the CPI and PPI reports. The Fed is losing its mojo. The Fed is losing its effect and its power within the markets. So we are not looking so much at CPI, PPI, and what the Fed is or isn't going to do anymore. We are focused on something else. I made a comment in the Telegram channel this morning that it's sort of like last year's fashion or last year's trend, or like Justin Bieber fans. I don't hear about Justin Bieber anymore, but I used to hear about it all the time when my girls were younger. Then they don't talk about Justin Bieber anymore. So we've moved on to the next big star, the next big trend, or the next big fashion statement in the markets. That new trend is tariffs. Everyone is focused on tariffs. What is Trump going to do? What is going to happen with the tariffs, and how is that going to affect certain industries and cost of goods and inflation and all of this? So the spotlight is no longer on the Fed, and it's more on what Trump is or isn't going to do, and what tariffs are going to, or what sort of effect tariffs are going to have in the markets. That doesn't mean that the Fed has zero say, but it just means that as long as they move within expectations or not too far away from expectations, then the market's just not really going to react. We have this CME, the FedWatch tool, now pricing in the chances of a 25 basis point rate cut in a few days at 94.7%. That's, I think a day ago was about 85 or 71, I guess. A week ago. So a day ago was 97. A day before that, it was 85. So we have increased to the mid to high 90s. We are going to get that 25 basis point rate cut. If we don't get it, then we will see this market sell off, just because, like, what the heck is Powell doing? He was the guy who was saying that, the inflation is transitory. And then 2 years later, he goes, oops, inflation wasn't transitory. And now he's like, inflation's under control. We're going to cut. And he cut by 50 basis points. That was a big oops. And then now he's on this trajectory cut, remember the Fed doesn't cut by 50 basis points, pause, cut by 25, pause, cut by 25. But no, when they go on cuts or raises in the interest rates, they're programs. They go one after the other. There's very rarely pauses in between. So for him to pause would just really be like, oh my God, I really made a big mistake. And I don't think he's going to make that type of admission right now at this point in career. He didn't do it with the inflation is transitory thing, and now I don't think he's going to do it now. So unfortunately, it is, well, we have no control over what the Fed does. The Fed does what it wants to, and we probably are going to get that 25 basis point rate cut. As long as everything's in line with expectations, then this market can just do that low volatility float up into the end of the year. We were talking about the possibility of 610 and 615 into the end of the year. You can see that it's not that far away. It's still very possible. And these little pullbacks to the EMA8 are very good and very healthy for the continued upward movement of the markets. So really, this is really no big deal. And I'm not expecting any huge movements. There's no real catalysts that can be foreseen or that are scheduled that would help this market go screaming higher or screaming lower. Of course, there's black swan possibilities and things that are completely off the radar screen. But from what we can tell, as long as everything operates as is, then we can expect this chop or low volatility floating upwards in the markets. Now, the other day, I also commented on XLV, how that was breaking down. I issued a bonus trade alert on December 5th and said that this could trade all the way down to 141 or 140. You can see that we closed at 141.01 today. So that would have been a very nice trade for anyone who took that. This does look like there is more potential. So we could hit 140 and even lower. But I wouldn't be too surprised. At this point, you can see that it is deviating from its moving averages quite a bit. We could pull back before moving further down. It could go straight down. We'll see from here. So far hasn't lost momentum, so there's no real reason for us to say, oh, it's going to pull back from here. But it wouldn't be surprising. It wouldn't be surprising if we pulled back from here. But until we see that momentum lost, like we see a doji candle or we see a long tail and a move back upwards, or we have a small green bar, something like that to indicate that this downward surge has ended, then we would expect a pull back to the EMA 8 or EMA 20 and then resume the downward movement. There's no reason for us to believe that the overall trend is done. It is clearly in a downtrend. It's just that the current move is a little bit more aggressive, just like this was a little bit more aggressive. And then we saw that green day, which indicated a loss of momentum. It pulled back to a little bit beyond the EMA 20 to the MA 200 and then pulled back down again. So this is really the same picture as what happened right here. We could pull back to the EMA 20. I think the MA 200 is a little too far at this point. It could be this year-to-date VWAP and then another leg downwards. So those are the biggest themes that I'm seeing in the markets right now, though at least the easiest low-hanging fruit money. Everything else, kind of this low chop sideways, yeah, you could throw some money in there, but it would just be this slow waiting game. If you're looking for faster, larger movement, then right now XLV is where the action is. That's it for today. I will see you in the next post-market review.